joining in right now, Gautam Chhaochharia. He is the Executive Director and Head of India Research at UBS. He's joining us right now on the show. Gautam, thanks very much for taking out the time. What's the call now at UBS with regards to the overall market momentum, the mood, the external risks that we are facing right now, the challenges globally as well as domestically?
Good morning, everyone. So global. Obviously, we are worried about growth slowing down further. In fact, we see growth slowing down quite sharply globally in fourth quarter and specifically in the first 2 quarters of next year, given the escalation in the tariff war between US and China. So that's not necessarily looking good for growth per se. It also means that we could have a more dovish Fed, which could support market sentiment beyond fundamentals. So those are the 2 moving parts globally. Locally, it's interesting. We have seen the policymakers respond to the growth slowdown, and our diagnosis of the growth slowdown is different versus what we keep hearing. In our view, it's a lot more of a negative feedback loop over the last 4 months than anything necessarily structural or cyclical or whatever terms we want to use. And any negative feedback loop which develops, including one of narrative, typically needs some kind of policy intervention. And finally, we are seeing policy intervention over the last few days and weeks. And again, depending on the scale and timing of further policy measures, that will determine the timing of this growth slowdown bottoming out and then shape and pace of recovery. We do expect further policy measures. But it's difficult to quantify as to what exactly will they do. Will they do fiscal stimulus? What aggression they will show in the monetary policy? That will also be key for us to take a view on how growth comes back quickly. But in our economists' view, we do expect growth to bottom out in the first quarter of this fiscal year and slowly start improving. Maybe the worst is in the September quarter, maybe. But otherwise, we do expect growth to bottom out. Whether it recovers back sharply, that will depend on the kind of policy responses we see going ahead from now on.
It's an interesting point, Gautam, you make, and we've been talking to a lot of managements, particularly companies which have, the exposure with regards to consumer goods and consumer durables, particularly anything that's related to consumption, whether it be slightly more discretionary, aside from the big ticket expenses like cars. So even for that matter, decorative paints growing at 15% in terms of volumes. Yesterday we had, consumer durables, 2 major companies talking about growth at about 8 to 10% come the festive season. You've got some the FMCG companies, essentials particularly, which don't seem to be in a downtrend because ultimately the consumer will spend on essentials. So is it more of just the fact that the sentiment is so beaten down that everything looks like a gloom and doom situation?
So clearly, as you said, it's largely a negative feedback loop. And the simple way to put it is when the NBFC crisis hit last year, we didn't see auto sales going down 20-30% Y and Y. They slowed down from growing in single digits to, say, flattish. And it's only over the last 3-4 months they have collapsed in terms of growing negatively 20-30% Y and Y. Similarly, for all the other consumer baskets, the slowdown has been much more pronounced over the last 3-4 months than earlier. And there's still pockets of the economy like power, steel, etc., which have showed no signs of slowing down. And they're still holding on. So clearly to us, the way we interpret this is over the last 3-4 months, what's happened is the initial impact of NBFC on autos and property has now started to feed into the rest of the economy because the negative impact of NBFCs, etc., were not really resolved and it didn't really stay isolated and started feeding in. And what's also happened over the last 3-4 months is beyond the fundamental impact of a feedback loop, the narrative loop also has become quite negative, which has also hurt consumer sentiment. And markets obviously are always reflect a more exaggerated version of the underground reality on both sides. And obviously pessimism in the market is even higher than the underlying fundamentals, primarily because of the disappointment from the new government in the budget. So that's also playing a role. But there is clearly a slowdown. In our view, it's largely a negative feedback loop, which the policymakers are trying to break, and it should help. and we should start seeing a bottoming out of that. But whether we see a recovery back to growth rates which we were seeing over the last 4-5 years, or lower than that, or even higher than the last 4-5 years, that debate is still out there and will depend on the policy measures the government takes in the next few days and weeks.
So what do investors do? Gautam, good morning. Neeraj here. What do investors do in a scenario like this? Where do they park the money? What kind of returns should be the base case estimates for investors from here on? Not just from a 12-month perspective, maybe that is too short right now, maybe from a 24-month perspective.
Good morning, Neeraj. So again, for markets, keeping in mind what we discussed about the growth, etc., the risk reward is still not attractive for the markets, because the index hasn't really come down that much and the valuations are still rich. So at an index level, we would say that the markets are fairly valued and the risk reward is not attractive to buy in here, at least from the next 2 to 4 quarters perspective. Longer term, I won't worry too much about the growth slowdown which we have seen over the last 6 to 12 months as reflecting anything more structural than what markets were hoping for, say, a couple of years back. So I won't worry too much about the long-term fundamentals, specifically in the context of what's happening globally. So the relative growth attractiveness for India should remain intact. But yes, near-term, these challenges are there. So depending on the investor's time horizon, if you're looking at next 2 to 4 quarters, risk-reward clearly not attractive. If you're looking at long-term, then this could be an opportunity to start dipping in. But again, ideally, you could get better opportunities in the short term, given the narrative out there. In terms of positioning, our preference is still for selective large caps. We're still underweight small and mid caps. And even with the selective large caps, you have to be very, very careful about individual stock. So we do like retail liability-driven private financials. We do like oil and gas, property, select individual names in the consumption space. We still underweight autos and industrials and mid caps.
Gautam, just one follow-up. What's the premise of this downside scenario target of 9,400 for December 2019? Globally linked, or would it be India's own doing that could lead to this?
It's obviously a mix of both. So if we see global risk-off sentiment continue leading to a lack of foreign inflows or even outflows, and in India we don't see a credible policy response, which means this negative feedback loop continues to develop, or we see a policy response which is at best settles it down but doesn't really drive a recovery, then the market multiples are still rich and could derate from here, and that's what drives a downside scenario.
Okay, you also done something that is similar to what we do, Gautam. I was reading one of the notes that you guys put out. Now we have this series called CFO Leaders, and I think what you've done amongst things that you've done is this CFO survey, which reflects some pessimism but some silver linings too. Can you tell us, based on that, what's the key finding there that could help from an investment perspective?
So the pessimism is obviously around demand. So demand outlook, rural, urban, and across company sizes is more muted this time versus last year at the same time. So that's clearly a moderation, but not really a surprise. The silver lining was around trends like hiring, for example, including more hiring of permanent labor. So that is holding on reasonably well. There was another silver lining of capacity utilizations picking up across sectors, but again the capex outlook per se remains muted, in fact more muted than last year, reflecting the sentiment out there. The other interesting takeaway from that survey was also around GST. So we're clearly seeing signs of the positive impact of GST in terms of the formalized sector gaining share or benefits in terms of reduced transportation time. Our survey suggests that that's peaked out last year, and they're not seeing any incremental benefits over the last 1 year. In fact, compared to last year, looks like the informal sector is not in as bad a shape as last year. So the formal sector is not seeing the competitive intensity reduce as a benefit of formalization this year compared to last year.
Gautam, just want to ask you, what is so different with regards to the downturn in the market? I mean, the noises even then were there, but it looks like the negativity is just amplified in this market correction, though the Nifty is down about 10% and last time when we saw the correction, the index actually fell more by 15%. But the negative undertone seems to be more this time.
So that's for a couple of reasons, I would say. One is the negativity reflects the high hopes the markets had post the new government coming in after the election. So as always, markets expect a lot of things to happen in the short term. And in that context, the budget was clearly a disappointment for the markets, not just because of, say, a lack of some of the big reforms, but also because of all those tax measures which dampened sentiment. So it's in that context. And second context is also the valuation. So while markets have not sold off so much at the index level, the broad market has. And that reflects the same thing, that they want to be hopeful, but the narrative clearly is pushing them back. So the starting valuations part and the starting expectations part is, I think, what's making the narrative a lot more weaker, while the continued local flows is still helping support the select large caps and therefore the index.
So, while we're looking at the broader market sell-off and the quantum of stocks that have lost out about 70 to 80% of their share value, I mean, that's quite a large number. Doesn't that probably prompt you, if you're looking at, starting to put money into mid-caps and small caps, to encourage somebody to say, hey, I mean, this looks like a right opportunity?
So there are a couple of points to be made there, and to explain why we are underweight small mid caps even now, or in fact 3 points. One is, if you look at the individual small mid caps, which are the quality ones which you would like to buy for the longer term, they haven't really come off. In fact, most of them are still trading at high multiples and near the peaks. That's the first point. The second point is, if you look at a broader mid cap, small cap indices, which have come down, reflecting some of the weaker quality names coming off quite sharply, that the relative valuations today versus the large caps looks one of the most attractive in the last 10-12 years. But if you go back before the 07-08 cycle and look at slightly longer term, then the relative valuation doesn't look as attractive. And the relative valuation looks more attractive on forward earnings than trailing earnings, so reflecting the higher hopes inbuilt into mid cap, small cap earnings. So at a bottom-up level, we still don't see enough opportunities at individual stock or broad indices level to really make a call of going overweight. The last point there would also be, typically if you look at stages of market cycles, small mid caps come to the cycle towards the last stage, or just before the last stage of the cycle. You typically see some of the individual large cap stocks do well, then the broader large cap indices doing well, and then the small mid caps come to the party. We're still some time away for that, and typically small mid caps, for them to do well, need a lot more visible and high conviction about the growth outlook, and also the local liquidity and risk appetite should be much higher. Those are still missing. But yeah, if someone is looking at 3 to 5 years, there's always opportunities, and specifically in small mid caps even now.
I wouldn't ask you to crystal ball gaze and tell me a level that you're looking at for the index. But just in terms of, the 1 or 2 things that you think could be a game changer for the market, whether it be on the upside or something, that in risk terms creates a lot of uncertainty with regards to, value at risk. Just the fact that you've seen so much erosion, but that one event could actually worsen the situation.
So I think the global factors, obviously, locally it boils down to policy action. So unlike various stages of market cycle, this time market direction on both sides will depend on the specific, the scale and the timing of policy measures by both government and RBI. If we see a very, very aggressive rate cutting cycle, or we see a more aggressive policy stance, including on the fiscal side, it could help market come back much more quickly. If the measures don't address the near-term growth concerns, or still still are targeted at long term without any clarity about when the growth comes back, then markets could struggle even more from here on.
Okay, Gautam, one set of questions from my end. As we look at the market today, what is doing well, and albeit it's a bit of a bounce, but all the commodity-linked stocks are doing well. ONGC is up about 5%, Coal India, Indian Oil, Vedanta, Tata Steel, JSW Steel. Now, these are bombed-out pockets, be it in the private sector or the PSU sector. Are you looking at this side of the market at all? Pockets which have been beaten down completely, and there is, it's as I'm borrowing somebody's term, a one day, someday kind of a trade, or one day, someday kind of an investment. Are you doing that at all?
So as a research analyst, we don't do that, obviously, from a one day, 2 day kind of trades. But fundamentals wise, we don't look at something if it's a government-owned company in isolation. But yeah, a lot of the PSUs or SOE companies fall into our overweight call on oil and gas sector or power utilities in India, for example. So there we do see opportunities of valuations being attractive in the context of fundamentals which we see playing out.
Yeah, no, what I meant was that someday or one day in the next few years or next few quarters, these companies might show a turnaround, and therefore are you trying to indeed log on to those pockets at all? My final question, at least from my end, Gautam, and that's on IT. Are you looking at that pocket at all? Somebody cited that because of the fact that the nominal GDP growth is now down to 8%, companies which are not necessarily growing at 15% but at 12% with stable ROCs and ROEs might actually find the filter of a lot of investors. Is that a reasonable argument?
That's a very simplistic argument to presume that 8% nominal GDP is the new trend nominal GDP for India. It's just a 1 quarter print as of now. The IT sector obviously has gone through its own cycles. We had been underweight for a long time. We turned neutral a couple of months back, and we haven't changed that stance. It has to be much more stock selective. The sector could work in a more defensive positioning in the Indian context, but also faces global headwinds given the outlook on global growth. So that's the twin challenges or twin drivers for IT right now, and that's what is driving our neutral call in the sector. And the buy rated name, if at all, would be more an individual stock basis rather than the sector call.